So if I could have your attention, please. Have your attention. Thanks, Mark. Please continue enjoying your lunch. We're going to go ahead and get the program started, though, in the interest of time. We are very pleased to have Spencer Dale, who's Group Chief Economist at BP, here to present BP's energy outlook, which was, I guess, just formally released a couple of weeks ago. So he's sort of begun his world tour. I believe we're the last leg in the U.S. before they take it international. And he has a lot of very interesting insights that have been developed from this work that he'll be sharing with you today. The format for today is Spencer's actually going to present for about 40 minutes or so, and then there'll be some time for questions and answers at the end. So as we move into Q&A, please, when you stand up and ask your question, be sure you identify yourself. That's just useful in general, particularly for putting context around the question. So I am not big on reading bios, but suffice to say Spencer is definitely an expert in this space, and I'm sure you will enjoy his talk. Spencer?
Thank you very much, Ken. Good afternoon, ladies and gentlemen. So please do carry on eating your desserts and your coffee. When I arrange my visits to America, I often say, so what should we do on a Friday? And the team in America say, you can't do any events on a Friday, Spencer. People work from home on a Friday. You can't do that. And Ken said, we can do one on a Friday. And as we was driving in, one of my team was saying, well, let's see how many people turn out on a Friday, Spencer. So I think the answer is when you're at the center of the oil and gas industry, possibly people come out and work on a Friday. So it's an honor to be here. It's an honor to be at the Rice Institute, as somebody said, in the heart of oil and gas. So thank you very much. For sparing the time to come out. So for those who aren't familiar, BP produces its energy outlook each year, looking ahead, thinking about the major trends affecting oil and gas markets over the next 25 years, so out to 2040. We produce this document to help us understand our own thinking and plan our own strategy going forward. As one of my roles as chief economist at BP, I sit on a committee responsible for thinking about the designing the strategy of BP. Now, at this point, some of you may be thinking, oh my goodness, I'm going to go and sell BP shares. This man actually thinks he can predict the future. No, I know I can't predict the future. I know any single forecast will be wrong. The value of an exercise like this isn't to predict the future, it's to better understand the uncertainty you face. And that's how we think about it in BP. By doing a whole series of what-if type statements, you can get a feel for which judgments and assumptions make a big change to the outlook, which ones don't shift it very much at all, and you can start to think about building a portfolio of assets, a portfolio of assets for your company, which is pretty resilient to a whole range of outcomes. So when I think about strategic planning for a company like BP, it's not trying to predict the future, it's trying to have a portfolio of assets which works well across a whole range of outcomes. And as a result of which, you don't need to look at the detail here. The point of this chart is just be, wow, they got a lot of those different scenarios here. We look at a whole range of different scenarios in the energy outlook, this whole series of what-if statements. The scenario I'm going to focus on most today is a scenario we call the evolving transition scenario. And the evolving transition scenario is sort of what it says on the tin. It's the sort of the broad path we think the global energy system is likely to be evolving along if government policies, technology, social preferences continue to evolve and change in a manner and speed seen in the recent past. So very loosely, if you like, the path we're moving along, absent a big shock to technology or policy. And then I'll then deviate away from that and consider other opportunities and other aspects of it. That's why we produce it. a sort of follow-up question is, well, why on earth, if it's so great, Spencer, why publish it? Why not just keep it for yourself? Which I think is a perfectly good question, which some people in BP ask. I think a good answer, and a truthfully good answer is, if you're any organisation, any company, any government organisation, your biggest risk, I think, is a danger of groupthink. It's a danger that all you do is speak to other people, you all convince yourselves you're right, and then you go down off in a particular path. The best sort of mitigant I know of group risk is opening that up for public review. If I stand up, I've been in US all week in combination of DC and New York. If you stand up in a room of 100 people and say, this is what I think, they love telling you what's wrong with it. And as a result of which, you come away a lot smarter at the end of it than you otherwise would have done. So that's sort of code for saying, when I do stop talking, feel free to tell me which bits are wrong and which bits sound wrong. If they sound wrong, they possibly may well be wrong. Tell me that, and I'll go away smarter than when I joined. One other thing, just to sort of, this is a long book, and you'll be pleased to know I'm not going to try and summarise all of it today. My real objective is when you leave, you take this with you, and as soon as you get back to your home or your office, you don't immediately throw it in the trash can. You think, perhaps I'll just keep it around just in case it's interesting. If you do, and you do look at it, you'll see that what we try and do is we look at the energy transition through three distinct windows or lenses into the energy transition. So first of all, who's using the energy? So look at it by sector, the who of energy. Then by region, by in terms of where is that region, which countries and regions are using that energy. If energy demand is growing in China, that has very different implications for the fuel mix than if energy is growing in India. So how's it going there? And then thirdly, by fuel in terms of the different energy sources which is going on. And by looking at these different behavioural drivers in each of these sectors, we hope to get a better feel for the energy transition which is evolving. Just in terms of a few headlines first, in terms of this evolving transition scenario, we have global energy demand growing by around a third by 2040. That's an average growth rate of around 1.3% or so a year. For those of you who don't have all these numbers in your head, an average growth rate over the last 25 years is about 2%. So continuing to grow, but slower than in the past, and that slower growth reflects quickening gains in energy efficiency. The world is just getting better at doing more with less energy, and as a result of which, even though economic growth continues, all of that growth needs less energy to power it than it did in the past. In terms of where that energy is coming from, all of the growth in energy demand is coming from developing economies, fast-growing developing economies, particularly China and India. The green bars here shows you energy demand within the OECD, the main developed economies. That's flat. All of the growth, when thinking about where's our growth markets for energy, is coming from fast-growing developing economies. The factor driving that growth in those developing economies is increasing prosperity. As productivity increases in the developing world, output per head increases, prosperity, income per head increases, and that's what drives energy demand. We think there's something like 2.5 billion people, a third of the world's current population, are lifted from low incomes to middle incomes over the next 25 years. And as you are lifted from low income to middle incomes, you can start having access to electricity, you can buy household appliances, families can save up to buy their first motor bike, then they can buy their first motor car, and that's what's driving the growth of energy demand over this period of time. If you look at the chart on the right, the two biggest drivers here are China and India, the two blue bars. All these charts are in the book if people can't see, but I'm afraid I don't know all the numbers off the top of my head, so I won't be able to do it. China and India are the two biggest growth markets, but what you can see is a sort of a changing of the order of the guard. China has been by far the largest source of growth for global energy markets over the last 10 or 15 years and continues to play that role over the next 10 or 15 years. But by the early 2030s, as China's economic growth slows and also its use of energy slows by even more, India emerges as the major source of energy growth for the world in the sort of for the last 10 years of the outlook. If I go back to that sort of those three windows and just briefly in terms of the fuels, what's going on in terms of which energy sources are driving this growth and supplying this growth in demand. Renewable energy, and when we talk about renewable energy in BP, we're thinking largely of wind and solar and biofuels. We treat nuclear energy, hydro energy separately because that's a far more mature energy source and so is growing less quickly. But renewables led by wind and solar are by far the fastest growing energy source over the next 25 years, accounting for around 40% of the total growth in primary energy in the evolving transition scenario, with their share shown on that right, that the steeply rising orange bar, rising from about 4% today to about 14% of primary energy by 2040. Natural gas, shown here in red, grows far more quickly than either oil or coal. This is a share chart, and so natural gas overtakes coal in terms of its importance in terms of global energy in the mid-2020s and converges on oil. And by the end of the outlook in 2040, natural gas providing around a third of the total growth of global energy supplies in this evolving transition scenario. Oil demand continues to grow for much of this outlook, but at a slowing pace. I'm going to come back and talk for too long about oil in a moment. The source of energy which has the sharpest change in the past is coal, which we essentially have flatlining over the next 25 years. So almost essentially zero growth, with quite sharp falls in coal consumption within the developed world and in China, where it seems increasingly likely that China's coal consumption has now peaked. But that's offset by continuing increases in coal consumption, particularly in Asia and other fast-growing Southeast Asian economies, where the emphasis there is on massive growth in electrification and the need to provide cheap and fast-growing energy to your citizens, and that's what's driving that growth of coal. That's a sort of very sort of quick 2-minute intro into the outlook. What I then do... One final point. This growth, particularly of renewable energy over the next 25 years, means that I think the world is moving towards having the most diversified fuel mix the world has ever seen. So this is the only chart that does this, but this chart starts in 1900, so to give you a sense of history about fuel mix. And this is looking at the shares of different fuels within the fuel mix. And you can see we're moving to a world where we think oil, gas, coal, and non-fossil fuels will each provide around a quarter of the world's energy. We have never seen such a diversified fuel mix at any point in history in the past, where there's always been one fuel, be it originally coal and then oil, which was the dominant source of energy. The reason why this matters is because that increasing diversification means the global energy system is becoming increasingly competitive over time. Energy demand is growing, but it's growing less quickly. Within individual fuels, say oil, there's an abundance of oil, with tight oil competing against OPEC oil. And now added to that, there's increasing competition across fuels with this diversified fuel mix. I think for companies like BP, that has big implications in terms of how we think about making sure we're competitive in the future. I think it also has significant implications for individual countries, where for much of the last 20, 30, 50 years, just having huge resources of hydrocarbons was essentially a sufficient sort of thing to know that you could have quite a wealthy and prosperous nation. I think in this more increasingly competitive world, that's no longer the case. So what I've got to do now, I have sort of 6 questions, which are sort of interesting questions, which is about the future, which we try and address in the Outlook. I think what I'm going to do, I'm going to do the first 2, and then I'm going to do a time check, and I may do some audience participation about which of the other 4 that we're going to get through, because I've got a horrible feeling if I try and do all 6, I'll either do it really badly, or I'll take miles too long and we won't have any time for questions and answers. So I'm going to start with this first one. Is what did we learn about electric cars and the mobility revolution? And what was it, just out of interest, I was in New York for the last 2 days, and when you're in New York, you speak to a lot of investors, and this was the thing they wanted to talk about beyond anything else. It was the most important thing in their minds, which is odd, because I'm going to try and persuade you I don't think it's the least bit important. But that in itself is sort of the rub. I framed it in terms of what have we learnt about electric cars and the mobility revolution, because I think certainly us at BP, we're still learning about this, how to think about this. And so this is sort of, if you like, our work in progress this year, and I'm sure if I come back next year, I'm thinking would have been moved on. One thing where our thinking has moved on is how to think about the measurement of how rapidly electricity is penetrating the car market. Most of you, if you have conversations about this, or if you read any analysis, almost all of that analysis is based around how many electric cars will there be in 20 or 30 years' time. Will there be 200, 300, 400 million cars? Instead, we say, no, there's a better measure of the penetration, which is what proportion of total passenger car miles will be powered by electricity. So in terms of total passenger car miles, what share of that will be powered by electricity? And we estimate that by 2040, about 30% of passenger car miles will be powered by electricity. Half of that reflects the increasing number of cars. So we're including the increasing number of cars, but that reflects half of it. So in our estimate, we have very roughly the number of electric cars on the planet rising to about 300 million cars. That's out of a vehicle car park in 2040 of about 2 billion cars, giving you about 15%. How confident am I of that 300 number? Not the least bit confident. But I will either come on to tell you, or I'm more than happy to tell you in Q&A, I don't think if I was 100 million wrong either way, the implications for oil demand are trivially small. So it is not a big deal being that wrong. So most estimates will give you a number like 15%. Some people may have it a 400 million number rather than 300 million, so they may have a penetration number more like 20%. I've got 30%. This is slightly odd, BP telling a story of electric cars penetrating the car market more quickly than other people. I know people thinking, there must be a trick here. No trick. What's doing the other 15%? The other 15% is the intensity with which those cars are being used. So when I think about the amount of cars powered by electricity, it's both the number of those cars and the intensity with which they're used. And the intensity story links to the importance of fully autonomous cars and shared mobility. Now, at this point, this all starts to sound a bit like science fiction, but we know fully autonomous cars are already available now, and we think they will become increasingly available over the next 5 or 10 years. Now, the cost of those fully autonomous cars initially will be so expensive that they'll be too expensive for most private individuals to buy. And so the vast majority of those fully autonomous cars will be built and purchased by fleet services providing shared mobility services. So think Uber, think Lyft. I told this story at another group and said, a few individuals may be able to afford them, but they possibly have chauffeurs at the moment. And this group was a rather sort of illustrious group, and quite a few of them were looking at their feet, thinking, well, that doesn't everybody. If you get into an Uber car or a Lyft and there's no driver, suddenly the cost of that service will go down by something like 40 or 50%. As a result of which, we expect to see a massive shift away from other types of transportations into fully autonomous shared mobility cars. The link to electric cars is the low running cost of electric cars relative to conventional internal combustion engine cars. Means nearly all of those fully autonomous shared mobility cars. Sorry, I should have gone back on this one. This growth here is this huge surge in the share of kilometres powered by fully autonomous shared mobility cars. And the point here is we think the vast majority of those fully autonomous shared mobility cars will be electric because of the low running cost of electric cars relative to internal combustion engine cars. And that increasing intensity gives you the other 15%. And what we're nervous about is much of the analysis up to now is just looking at the first bit of it, the number, and not thinking about the intensity. This also means sort of the conversations you now have about electricity are slightly more interesting. If you're BP and you say any number for the number of electric cars, people will say it will be more than that. Whatever number you say, it will be more than that. And so you have an almost sort of pointless conversation that whatever your number want, the risks are always on the upside. I don't know how quickly autonomy will really take this effect that we have here. It may well be 5 or 10 years later than we suggest, but it's quite hard for it to be 5 or 10 years quicker than we suggest, because that's now. And so what this does is it starts to suggest there's more than just an upside risk to this. There's a two-sided risk when thinking about this. You need to think about the number of electric cars, but you also need to think about this autonomy and this intensity effect, and that's an important point. We then go on and argue that if you just look at the numbers, and I won't try and bore you with all the stuff, the impact of this scenario on oil demand is it reduces oil demand by around 2 million barrels a day by 2040. This is a market which today is consuming something like 97 million barrels a day and is likely to grow to well in excess of 100 million barrels a day. Just the arithmetic, and I'm more than happy to answer any Q&A at the end, reduces oil demand by about 2 million barrels a day. Let me show you another story so you can get your arms around that so you can sort of think about it. You think, well, come on, BP must be doing a trick here somewhere. But perhaps electric cars are going to go really rapidly, far more rapidly than BP think. So what we do is we consider a scenario where we say, let's suppose there's a worldwide ban on the sales of all internal combustion engine cars from 2040 onwards. So internal combustion engine, ICE, and ICE ban. So this is our ICE ban scenario. To make the ICE ban scenario really difficult, don't put just a ban on internal combustion engine cars, also put a ban on plug-in hybrids as well. So the only car you can buy from 2040 onwards is a battery electric car. And also, don't just put a ban in 2040, so just keep it all unchanged up to 2039 and then ram it in. Embrace this absolutely. So the green line here is showing you the share of battery electric cars in this alternative scenario. So it gets to 30% by 2030, two-thirds by 2035, 100% by 2040. The blue line is the alternative scenario. And as a result of which, battery electric cars account for around two-thirds of passenger car miles in 2040. For those of you scratching your head saying, well, why is it only two-thirds if they banned them? That's because there's some cars which were sold before 2040 and they stay in existence. And that's sort of worth remembering when we're thinking about the pace at which electric cars can penetrate, because there's a sort of long history when you're thinking about this, because internal combustion engine cars stick around for a long time. So this ban is more aggressive than any ban any country in the world has suggested. And I've applied it across the whole world. Delhi to Doncaster, Moscow to Montana, everywhere. So what impact does this have on oil demand? We estimate that relative to the evolving transition scenario, it reduces oil demand by about 10 million barrels a day. Now, that's a significant reduction in oil demand, and that reduces the amount of oil demand in the car sector by roughly half relative to the evolving transition scenario. But under this scenario, the level of oil demand in 2040 is still higher than it is today. The suggestion that you read about in newspapers and in commentary that the rapid growth of electric cars will lead to a precipitous decline in oil demand is just not borne out by arithmetic. There's no modelling here, there's no fancy deep theory, this is just a set of identities, a set of simple identities of how the car markets and assumptions about how much oil a car needs. And I've got a more rapid growth, a more extreme band than any country anywhere in the world has suggested, and I've applied it worldwide, and the level of oil demand in 2040 is still higher than it is today. An interesting question then is to say, well, okay, but what impact does this have on carbon? Is this a big contribution to solving the carbon problem? I'll just briefly introduce this chart, but the details of it we won't be able to get into. The blue line there shows the growth of carbon emissions in my evolving transition scenario, and that's growing by about 10%. The orange line, we have really good snappy titles for all our scenarios, the even faster transition scenario. You want to know about the faster transition. I'm not going to show you about the faster one. I'm just going to show you the even faster transition. The even faster transition scenario you can think about as being entirely consistent with meeting the Paris climate goals. That's how to think about it. And that suggests that rather than rising by 10% out to 2040, carbon emissions need to fall by about 50%. So if you like, that gap between the plus 10 and the minus 50 tells you the sort of carbon challenge that we face if we're going to get on a path consistent with meeting Paris. So what impact does this ice band do in terms of closing that gap between the plus 10 and the minus 50? Almost nothing. Electric cars have many benefits, very important in terms of health benefits, in terms of urban air quality. But a reduction of oil demand of 10 million barrels a day, although welcome in this context, just does not move the dial in terms of carbon emissions. And again, this is just arithmetic. There's no modelling here. So that's sort of very roughly. There's a whole heap of other work we've been doing on electric cars, but that's enough to provoke, at least I would have thought, some responses. I can say that we gave this presentation in some places in New York where there were some quite strong proponents of electric cars, and they responded quite aggressively to some of this. But I think ultimately not deeply, because this is not fancy economic modelling, behavioural assumptions and estimated equations. This is just pretty much simple arithmetic going on here. My second question, which is a related question, is all related to peak oil and everything we keep hearing about peak oil. So when is global oil demand likely to stop growing? And the truthful answer is, I don't know. And I think that's quite important as it is, because there's like a cottage industry of people that want to keep predicting when oil demand is likely to stop growing. I don't know. Let's start with what happens in the evolving transition scenario as the first pass. This is the evolving transition scenario, and in that scenario, oil demand continues to grow for much of the outlook, and it grows by about 13 million barrels a day, getting close to 110 million barrels a day towards the end of the outlook. But you can see the pace of that growth is gradually declining over time, and it starts to fall in the very last period of the outlook. What's driving that slowing growth is a slower growth in the transportation sector, the dark bars here. The world continues to has huge demand growth in transportation services. So transportation services in freight services and passenger services more than double over the next 25 years in this evolving transition scenario. But the planes, trains and automobiles we use to do all those transportation services get more and more efficient, and as a result of which the stimulus from transportation gradually declines. As an aside, you can see here that in terms of growth, the largest source of growth for oil demand in the last 10 years of the outlook is not the source of oil as a source of energy, but rather oil as a feedstock, particularly into the petrochemicals sector. So non-combusted use of oil takes over as a predominant driver of the growth of oil. Now, I guess 2 points I would make from this chart. One is the pace of the decline here is very slight. Total oil demand in that final 5 years declines by less than 1 million barrels. So less than half the growth, around half the growth we saw last year. So think plateau, not peak, is I think the right way of doing it. But this is just one scenario. It may well be wrong. Let's look at a whole range of other scenarios. So that top line there is the one we just looked at, the evolving transition scenario. That starts to decline in the very end of the 2030s. The next one down is the ice ban. That's going. The next one down is the ice ban. That peaks in sort of the beginning of the early 2030s and coming down, but the level of oil demand is still higher. The orange line there is the level of oil demand consistent with that even faster transition scenario I was telling you about a moment ago, with oil demand getting to about 85 million barrels a day. If you don't like my sort of scenario consistent with Paris, if you look at the IEA's Sustainable Development scenario, that has about 82 million barrels a day in 2040. From 10,000 feet, this is a flat line. Nobody expects oil demand to grow very rapidly over the next 25 years. Nobody expects it to decline very rapidly over the next 25 years. The significance of whether the first derivative is plus 0.1 and 0.2 or minus 0.1 or 0.2 seems to me completely irrelevant. This obsession about exactly when oil demand will peak just seems to be not particularly sensible. To a first-order approximation, this is a flat line. To think about this in another way, this line here is just a thought experiment. It says, suppose the world stops investing in oil today, and we assume that existing oil facilities decline at a 3% decline rate. Now, there'll be many people here who know an awful lot more about oil than I do, and they will think 3% if we stopped investing is a ridiculously low number. But let's stick with that low number. It's fine, okay? Even that low number, even with that low decline rate, the world would be able to produce around 40 to 45 million barrels a day in 2040. This big and ever-widening gap between the amount of oil the world will be able to supply and this cluster of oil demand profiles tells you, under almost any scenario I can think about, the world will need significant amounts of investment in new oil production for many years to come to provide the world the oil the world needs, even in a 2 degrees, in a sort of scenario consistent with meeting the Paris climate goals. When we were talking about the uncertainty we were talking about earlier and how we use this, I don't know which of those 4 demand profiles we're going to be on, but I'm pretty confident there's a big gap between most plausible demand profiles and that black dotted line, and that's why BP has a strategy of continuing to invest in oil, because we're doing that type of analysis. Just very briefly, in terms of where does that oil come from, for the 25 years, there's sort of various sort of netting out and so on, but around half of the oil comes from US tight oil, and around half of it from OPEC members. And the sort of story we tell is the lion's share of oil production over the next 15 years is largely driven by US tight oil. And then, as US tight oil starts to plateau out, OPEC members start to emerge and start to gain market share and start to produce more of their oil. And that's the sort of story we have. But a significant uncertainty when doing that is just understanding the potential scope for US tight oil. And at this point, I'm very scared, because I can't think of a more intimidating place than talking about US tight oil than here at the heart of this. So this is very much, I'm putting this out there, you can then correct me then when it's wrong. This is sort of a ridiculously simple point I wanted to sort of think here. But so let me set it up. In the evolving transition scenario, we assume that US tight oil grows by around another 5 million barrels a day, and getting to there in the early 2030s and sort of plateauing out at around 10 million barrels a day in terms of US tight oil. And we think that's broadly consistent with the level of rigs remaining around current levels, and all that growth being driven by increases in productivity. But when we're thinking about how this may be wrong, The point I was trying to explore is there's two big uncertainties when thinking about how tight oil may evolve over the next 10, 15 years. One is just what's the resource base? Just how productive is US tight oil? How much oil can we get out the ground? But there's also another source of uncertainty, which is how quickly will we get it out of the ground? How available will finance, fracking crews, and the SAM we're going to put down the wells? How available will that be in terms of the pace at which we're going to get it out? So think of this first scenario says, well, suppose that availability of capital, particularly capital and fracking crews, allow us to get this oil out far more quickly. And as a result of which, under this scenario, the level of oil demand, the level of oil supply gets to about 12 million barrels a day by the mid-2020s. But because I'm assuming I know nothing about geology, so I'm not learning anything about geology, then it has to fall off far more quickly, so the overall production is unchanged. And you can see in the right here, this is pretty plausible. You don't need a ridiculous number of rigs. It's rigs going back to where their peak levels were in the past. The alternative case is, well, suppose the underlying productivity of the lower 48 is just bigger than we thought, say 50% more production. So in this scenario, about 70 billion barrels are produced from tight oil between now and 2040. Suppose we think about it's close to a little over 100. Then you have this scenario here, this greater resource scenario, where tight oil could get to 15 million barrels a day and then remain there. The variations in terms of that resource base is relatively small compared to the range of external forecasts out there at the moment. So one answer is we don't know. The other interesting point I thought from this is, over the first period of time, these paths all look pretty similar. So if, for example, suppose we see really weak growth in US tight oil over the next 2 or 3 years, is that because actually the resource base is not very good? Or is that just because the finance needed to generate and get that oil out of the ground is slower coming through than otherwise be the case? There's two sources of uncertainty here, and it may be quite hard for us to know and distinguish between these things in the near term. Is if we see fast or slow growth, is that just telling us about the timing effect, we're going in and coming out, or is it telling us about the long-run resource base? Now, somebody was waving to me and saying, I've got 5 minutes left. This is where we're going to do the crowd participation. So I've got 4 questions, and I think I've only got time for one of those. So one is this so let me just give you a taste. So renewable energy, and how could we carry on getting renewable energy wrong? How resilient is the outlook for natural gas? Is a transition to a lower carbon energy system happening fast enough? You sort of saw the answer there. No, there's a big gap between the two. And finally, which perhaps, unless people have strong views, perhaps will be a nice one to do here, is what does all this mean for the role of the US in global energy markets? So unless I hear any... the man over there put his thumb up for the last one. For the last one, sir? Right, OK. So at this point... I'm going to, you'll have to excuse me because I'm going to have to whiz through these charts to the point. Okay, so what role will this play in terms of global energy markets? And this is clearly a very topical issue over here in the US at the moment. So the point number one is this enormous growth we expect to see in US tight oil and shale gas means the US, we think, in our evolving transition scenario, just emerges as by far and away the world's major producer of both oil and gas, with clear daylight in terms of their production of both oil and gas relative to any other country. So in terms of oil here, US total oil production gets to a little over 20 million barrels a day. Compared to, by 2040, Saudi Arabia's oil production, which is a little less than 15 million barrels a day. So clear daylight between the US and the next largest producer. In gas, that daylight's even greater. In natural gas, the US is accounting for around a quarter of the world's total production of oil, of natural gas, with the next largest producer, Russia, about 15%. So enormous, huge leadership role for the US. But the but is not only does America remain a huge producer of oil and gas, it also remains a huge consumer of oil and natural gas. It remains the world's largest consumer of natural gas and the world's second largest consumer of oil. And so in net terms, in terms of its exports, it's continuing to play a relatively small role. Now, this is one of those charts where you say, God, why on earth did that presenter put that chart up? I can't see anything. The US is that little line there. That's the point. You can't see anything. The net exports of the US remain very small. And if you like, putting that in sort of more concrete terms, the combined exports of the US of oil and gas are less than half that of Russia. So the way I think about the emerging role of the US is if I go back 10 or 15 years, the US had a quite significant vulnerability in terms of energy. It was a major energy importer. Around half the US's current account deficit was energy imports. That sort of vulnerability and dependence, I think, is almost already now and within the next few years will be neutralised. And so that weakness, that sort of dependency has been neutralised by this huge growth in tight oil and shale gas. But that's not the same as it becoming a major source of strength, because in terms of net exports, it's a relatively small net exporter because it remains such a large consumer of it. Just one other point to note here, the US was a major leader in renewable energy, but that has ceded that leadership role in recent years, and we expect that the role, the importance of the US in terms of generation of renewable energy to decline over this period, over the next 25 years, with the China and increasingly India taking by far and away the dominant producer roles. One may argue, well, I don't really mind. Renewable energy isn't traded, so that's not an issue. The alternative argument is this is the fastest growing source of energy in the world. It's where the most technological breakthroughs are happening in the world, and it may be that you would be worrying about not playing a leadership role in that space as well. Now somebody's going like that to me, so I really should stop. So there is lots of other time to do questions, but let me... That's not too bad. Let me. I'll stop there, and then we'll throw it open for questions. And as I say, please do. This audience is a thrill coming here because it is one of the most expert audience I ever have the opportunity to speak to. So please do. If there's bits which you think I'm not sure, Spencer, please feel free to say, because then I'll go away smarter than I joined. Thank you very much. Sure.
So if you have any questions, please start right here.
And then the lady in the red jacket after that one. You may just need a mic.
Thank you. Mike Loudon, retired ExxonMobil. For the last several decades, we've certainly enjoyed the fruits of free trade, and this may be an obvious question, but a timely one. So in your analysis, did you look at any case where trade wars broke out?
No, it's a really good question. We thought about doing it, and we didn't. And it may be we should have done. So in the past, when you're trying to, for many, during the period of globalization, for every sort of 1 unit of GDP growth, trade grew by about 1.2, 1.3 trade activity. So it expanded by more. And so that's why you had this rapid growth of trade activity around the world associated with globalization. Since the financial crisis, that multiplier has become significantly less than 1. So essentially, activity is happening, but the trade intensity was declining, or nowhere near as big. In this outlook, we've gone somewhere between the two. So we've got it slightly less than 1, but not back to the sort of the 1+ numbers we saw in the past. And that trade activity matters a lot, particularly in terms of transportation services, because things need to be transported around the world if you're trading them around the world. And that's where it sort of bites in this outlook. We haven't done the impact of trade, and I think what impact would that happen? I think it would have two. So one, most obviously, is there's less trade, there'd be less demand for transportation services. The far more significant thing is, I think you all know economists, and you may all rub your and shake your head when you hear economists because they always disagree. If you have 10 economists lined up on against a wall, perhaps the one thing all 10 would agree with is trade is beneficial for global growth. It's about the one thing all economists, I think Ken would agree with. It's about the only thing 10 economists would agree with. And so if you did have significant impacts, I think the bigger thing here is you'd have to then say economic growth would be significantly weaker. And if economic growth would be significantly weaker, the impact on energy demand would be far greater then, because the big driver of energy demand is economic growth, and that's how it would then feed back into the model. But we haven't done that, but it's a fair challenge. The lady there.
Hi, my name is Janet McElligott. I was formerly on the personal staff of President George H.W. Bush, but I've done a lot of work in China and in Africa. And I don't understand why you didn't have much significance for Africa and the growth, because they're going to be responsible for about 50% or more of the population growth. Does this have anything to do with the fact that there's so much corruption there, or what?
So, fantastic question. Over the next 25 years, Africa has about 50% of the population growth, about a third of the urbanization we expect to see. And in the evolving transition scenario, so 50% of population growth, 30% of the urbanization, less than 10% of the growth in GDP, and 10% of the growth in energy. What's going on? Why? As a matter, again, of identity arithmetic, that's because our view is that productivity growth in Africa remain very weak. And there's quite a bit in the book about thinking about the nature of that productivity growth. So it's, in some sense, quite a depressing story, but there's also, it tells you, an enormous upside. I think of this in a sort of, it's maybe a sort of somewhat clumsy analogy, but it's like a sleeping giant. All I need is India to start to have some tiny pickup of productivity growth. And that tiny pickup of productivity growth could lead it to have huge growth in GDP and also huge growth in energy demand. And so I think, if you like, what's the biggest factor which is going to drive energy demand and the pattern of energy beyond 2040 is what happens in Africa. And just for those who aren't familiar with this sort of macroeconomic stories about productivity, you don't need to be, people in Africa, people in China, people in India don't need to be inventing new things and being super productive and super sort of innovative. Levels of productivity in India today, in China today, about 20% those in America. In India, they're about 10%. All they need to do is get their binoculars out, look at best practice and start adopting that best practice. For that huge growth in China, the levels of productivity relative to America go from low 20s to the mid 40s by 2040. So, and in Africa, they're incredibly, incredibly low. So all you need to do is a very small adoption of best practice technology, and that can drive economic growth for many, many years to come. But that's a problem with Africa. But there's some special sections on Africa in here to try and sort of look at that issue. I have a gentleman midway down on this side, if somebody has them. Oh, sorry, sir. Okay, so that would be a bit rude not having the man with the microphone and then have a question there. Yes.
My name is Carlos Fernandez. I'm retired from Hewlett-Packard. The question that I have is, when you compare this year's energy outlook compared to last year's, what was the major change? What was the biggest surprise of any significance?
Renewable energy. And if I was being honest, if you'd asked me that the previous year, I would have said renewable energy. And if you'd asked me that the previous year, I would have said renewable energy. And you think, God, Spencer, you're not a very good learner, are you? But I mean, I'm being serious. We have been systematically surprised by the strength of renewable energy, particularly solar energy. I hold my hands up. My only defense is, so has everybody else. Almost everybody else. If anybody knows anybody who 2 years ago predicted the growth of solar energy that you've seen over the last couple of years, please tell me. Because so What's going on there? Some of that growth, enormous growth in solar energy, is coming about just because the technology gains are just quicker than we expected. But a big chunk of it is also because policy support has just been greater than we thought. So about half of our error, or half of our upward revision, if you like, is in China and India. It's not just global, which it would be if it is all just technology. It's because the level of government support in China and India has been greater than we had expected. As a result of which we have an even bigger profile now. But in the outlook, that sort of that question I had, which is just how fast will renewable energy grow, takes you through an alternative scenario where we say, well, let's suppose we keep getting surprised again. Just how much could that be? And let's explore that. And sort of that's what we're doing there. But it's the amazing growth of solar energy and over the last few years, and the implications that has for the future has been the biggest surprise. So I did have this gentleman here, and then okay, so I have one gentleman here. Sorry, sir. I'm going to stop now, Ken, and you're spotting it, aren't you? Right, from now on, Ken's conducting from now on, because I keep getting this wrong. Yes.
I'll be quick. My name is Arne Grau. I'm professor of physics at the University of Bergen in Norway. We all know there are twice as much energy in hydrates than all the oil, gas, and coal combined worldwide. Have you considered disruptive new technologies to produce these vast amounts of gas?
So, yes, and we have, and I'm more than happy to be told we haven't done a good enough job of it. So we think in some countries, Japan, China, they will be significant. We think the growth rates you could see in those countries could be very rapid, those growth rates, but they're starting from such a small base, they just don't move the dial on the global picture over this period of time. So for individual countries and individual bits, and they may well be, but they're not moving our dial significantly. So here, and we may have to take this offline. One of the things I often think about technologies is, one is there's a potential in terms of technology, but in a world of enormous abundance, for an energy to be exploited, not only does it have to be there, but it has to be really cost effective for it to be exploited, because we're not short of energy. The world's never going to run out of oil. The world will never run out of natural gas. Renewable energy is growing and growing and growing. At the same time, energy demand growth is growing less slowly over time. And so part of the story about which energies will be exploited is the fact that they're there isn't a sufficient thing. It's necessary, but it's not sufficient. It's also, can they be produced on scale at an economic rate competing against all these other types of energy? And so we have some growth in some of those in some of those countries, but not enough to move that global picture here.
Hi.
And then Ken, this is my notes. Yeah.
Hi, Dan Cohan, Associate Professor of Environmental Engineering here at Rice. Greatly appreciate that you're doing this even faster transition scenario to at least look what would happen if Paris was taken seriously, something that our government's EIA doesn't even model. IEA does something similar, so could you comment on how your path to meeting Paris compares to IEA or any other outlooks out there?
Yes, and absolutely. And I think the truthful answer is we're all pretty much the same. And if we're not the same, I wouldn't really place any more weight on mine relative to theirs. I think in terms of the precise policy profile underpinning this, we're getting to the limits of what we can really do. I wouldn't use my even faster transition to provide precise policy advice from it. And what I often do, and in last year's outlook we did it explicitly, we said, let's look at 4 or 5 alternative scenarios, all consistent with Paris climate goals, and let's look for common components in them. And if all of them have these components, then we can perhaps be more confident that that's a part of it. And perhaps one point here is one thing which is common across ours, the IEA Sustainable Development Scenario, the MIT's 2-degree scenario, is when you look at what closes that gap from the +10 to the -50, if you like, the vast majority of this is coming from the power sector. It comes from the power sector sort of for 2 reasons. One is the power sector is a huge absorber of primary energy. And secondly, it's where fuels compete side by side. And so relatively small shifts in relative prices can have really big impacts on the fuel mix. In the UK, and about 2 years ago, we introduced the carbon price floor about 20 sterling pounds, so very low, as a result of which we have almost no coal-fired power generation in the UK at the moment. I have a rule when I'm talking to policymakers or officials, if they say, Spencer, I want to have a serious discussion about reducing carbon emissions. And I say, fine, let's talk about the power sector first, and then let's talk about the power sector. And if we've got any spare time, let's talk about the power sector some more. If you're speaking to somebody serious and then they say, let's have a serious discussion, and they're not talking about the power sector, really ask them why. Because that's, I think, the message, one of the messages I take strongly from ours, but from the IEA and other people, that's where the action is. And it seems slightly odd where we have so many other discussions about so many other things under the pretense of carbon, rather than really just addressing the really serious thing. Now, to get all the way, you'll need to do that more than just the carbon, but the power sector, by golly, you can go an awful long way by taking that power sector seriously.
Over here. Oh, is that on? I'm Sean Mulher. I work as a journalist and grant writer downtown. The biggest problem I have with automated vehicles would be every destination that you go to will be recorded. There will be no privacy left. I'm just thinking with autonomous vehicles, we're going to have blockchains of where your destination is, who you associate with. Pretty much all the miles you travel is recorded into a system.
Yes, I guess, so I think that must be unambiguously true. I guess two things. One is how much you dislike that is that there becomes a personal choice. And I guess my other thing is I don't know, but my hunch is people know exactly where you're going now with the amount of CCTV cameras everywhere. So, and it may be collected more efficiently, but I'm not sure how much different it would be relative to where we are now.
We've got time for one more, so let's go right here.
Doug White from Emerson. In the evolving transition scenario, what did you estimate the atmospheric CO2 levels would get to by 2040?
We didn't. And we didn't for two reasons. One is we're only doing energy components, so we're not doing land use, so we can't look at that component of it. So we don't have the land use, which is the other sort of big emitter of greenhouse gases. And also, whenever I speak to scientists, they always tell me the sort of the mapping between carbon emissions and temperatures is an extraordinarily imprecise science in itself. And so I'm sort of nervous about pretending to do things that I can't do in the outlook. So if I put up some really provocative thing on the impact of an ice ban, I'm pretty damn confident that arithmetic's okay. And if it wasn't, people would love to point out that BP's made a mistake and they're overcooking their numbers. And so for this bit, there's two bits of that sort of equation which I just don't have a good handle on. So I just do those, that carbon emissions. But I think the IEA does do a far more sophisticated thing. And so we're looking at one bit of that. And that even faster transition scenario is consistent with what the IEA thinks, I think, would be materially the sustainable development scenario which they look at is consistent with temperatures rise significantly below 2 degrees C, I think, is what they argue. I think that is right, but a lot of this is happening off the page in the sustainable development scenario as well as ours, is what happens to carbon emissions beyond 2040 and how quickly they go down beyond that. But we don't do the temperature thing, I'm afraid.
Everybody join me in thanking Spencer.
Thank you very much. Thank you.